Welcome to this explainer. Today, we're unpacking a truly fascinating story, the incredible operational turnaround and the somewhat hidden structural risks of AXT Inc. If you follow the semiconductor space at all, you already know that the massive demand for AI compute infrastructure is completely reshaping the global hardware ecosystem. Well, sitting right at the absolute bottleneck of this global boom is AXT. They provide the fundamental materials that actually make ultra-fast data transfer possible. So we're going to look closely at their numbers, their market position, and the geopolitical tightrope they are currently walking. Okay, let's just dive right into this absolutely jaw-dropping number, 164.8%. In the second quarter of 2026, AXT saw this explosive year-over-year revenue surge, hitting an impressive $47.59 million. And this wasn't just a slight beat. They substantially outperformed consensus expectations, which were sitting way down around $34 million. For a company that was facing severe cyclical headwinds just a year prior, this is a massive operational inflection point. The main catalyst here is an unprecedented wave of orders from global hyperscalers who are aggressively building out their artificial intelligence data centers. To really understand why they're surging, we have to look at what AXT actually produces. And that brings us to indium phosphide, or InP. Now, traditional silicon substrates are starting to hit physical bandwidth limits in these ultra-high-frequency environments. But indium phosphide has unique physical properties, like a direct bandgap structure that essentially allows it to process light and electrons much, much faster than silicon. Think of it as the critical, high-speed physical highway you absolutely need to connect ultra-fast AI data centers. As these hyperscalers transition to 800G and 1.6T optical transceivers, InP has rapidly become the essential raw material for modern optical connectivity. Now, it's worth noting AXT isn't the only player in town. They compete with massive global conglomerates like Sumitomo in Japan and Freiberger in Germany. But AXT dominates a huge chunk of this highly specialized market, and the reason is their proprietary vertical gradient freeze, or VGF, crystal growth process. This specific manufacturing technique yields wafers with incredibly low defect densities and superior mechanical stability. And look, when you're dealing with advanced photonic processing for generative AI, low defect density isn't just some nice-to-have feature. It is an absolute non-negotiable technical requirement. This dramatic pivot is just brilliant to see mapped out over time. Back in fiscal year 2025, their total revenue actually contracted by 11.1% year over year, dropping down to about $88 million. It was a severe cyclical slump. But then, the AI optical cycle kicks into high gear, and we see this stunning sequential rebound. Q1 of 2026 jumps 39% year over year, and then, bam, straight into that record-breaking 164.8% growth in Q2. It perfectly captures a company rocket shipping out of a contraction and directly into an AI-catalyzed supercycle. But honestly, it's not just the top-line revenue that's impressive here. It's how that revenue translates into pure profitability. That massive surge allowed for significant fixed cost absorption. Basically, their factories became highly efficient as they produced more volume. And in the crystal growth business, volume is everything. As they scaled up, AXT's non-GAAP gross margins skyrocketed. They went from a measly 13.1% in 2025 up to a remarkable 45% in Q2 of 2026. That is a profound expansion in operating leverage in a very short amount of time. To support all this growth, AXT has fundamentally de-risked its financial foundation. They pulled off a landmark $632.5 million secondary equity offering, leaving them with a massive war chest of nearly $750 million in cash reserves by the end of Q2 2026. Plus, their indium phosphide backlog has expanded well beyond $100 million. They've secured these huge multi-year supply agreements backed by almost $48 million in non-refundable customer prepayments. So this non-dilutive financing is actively funding their capital expenditures as they target an enormous $130 million quarterly capacity by year-end 2027. So here is the million-dollar question. With numbers this good, gross margins expanding rapidly, an incredibly strong balance sheet, and a seemingly unstoppable trajectory, why is Wall Street's consensus strictly a hold or neutral rating? What are the structural headwinds keeping the broader market so cautious on a company growing its revenue by over 160%? Let's explore that by looking at the valuation disconnect. The first big clue is the staggering premium AXT commands right now. We're looking at a trailing price-to-sales ratio ranging from roughly 37 to 45 times sales. To put that in perspective, the broader semiconductor materials sector averages just 6.9 times sales. Even looking ahead, their enterprise value to EBITDA is astronomically elevated. Yes, consensus estimates project their top-line growth at around 60% annually over the next 3 years, way above the industry forecast of 25%. But trading it up to 45 times sales implies that absolute perfection is already priced in. It literally leaves zero margin for operational error or shipment delays. Which brings us to our second major risk factor, the insider sell-off. Usually, when a stock is priced for perfection, you want to see leadership holding onto their shares tight, signaling confidence in that multi-year growth narrative. Instead, SEC filings reveal a very different story. Between March and June of 2026, top leadership quietly liquidated a massive portion of their holdings. Director Jesse Chen executed open market sales of over $18 million. CEO Morris Young liquidated shares and proposed selling an additional block totaling around $16 million. CFO Gary Fisher sold over $4.5 million in March alone. Add it all up, and top leadership sold over $42 million of their own stock in just the first half of 2026, while the price was soaring. And you know what makes those multi-million-dollar liquidations even more noteworthy? It's what didn't happen. There were absolutely zero open market purchases recorded by senior executives over that same time frame. The fact that insiders are aggressively cashing out while completely abstaining from buying paints a highly cautious picture for any near-term upside. Look, when the CEO, the CFO, and key directors take tens of millions of dollars off the table with perfectly timed precision, investors definitely need to take notice, especially with a valuation multiple this demanding. Finally, we need to look at the macro view, geopolitical bottlenecks. Zooming out to the global stage, AXT conducts its primary crystal growth and manufacturing over in China through its subsidiary Beijing Tongmei. While their vertical integration is generally a huge positive, they own stakes in over 10 Chinese raw material suppliers, it makes them incredibly vulnerable to multi-jurisdictional compliance. Why? Because they are directly subject to China's Ministry of Commerce, which requires strict export permits for dual-use materials. We're talking about regulatory restrictions covering the exact materials AXT needs to survive: gallium, germanium, and, crucially, indium phosphide itself. This is not just some theoretical, maybe someday risk. It is actively impacting their projections right now. Management openly admitted in their Q2 earnings commentary that hitting their $66 million revenue projection for Q3 relies heavily on the whims of Chinese regulatory authorities. That's a severe structural bottleneck. Any geopolitical friction that delays permit processing by even a few weeks can introduce massive shipment volatility. And like we said, a stock price at 40 times sales simply cannot absorb a revenue miss without a major correction. So let's break down the catalyst watch and the road ahead. To navigate this paradox over the next 24 months, there are a few key things investors gotta watch closely. First, October 2026. Assess their Q3 execution on that $66 million revenue target, and specifically see if those export approvals actually came through smoothly. Then, look toward the end of 2026 and track their progress toward a $60 million quarterly indium phosphide capacity run rate. Finally, as we track through 2027, the market is absolutely going to demand to see successful operational deployment of that massive $632.5 million capital raise to double their manufacturing output and hit that $130 million capacity target. We'll leave you with this final thought to explore. In a sector where infrastructure demand seems practically infinite, but valuations are astronomically high and supply chains are deeply fragile, where exactly do you draw the line between a visionary technological investment and a hazardous geopolitical risk? Understanding AXT's indium phosphide boom gives us a perfect lens into the immense opportunities and the huge vulnerabilities powering the next generation of artificial intelligence. Keep questioning the data, keep analyzing the trends, and thanks so much for joining us for this explainer.